Hey everybody, thank you so much for checking my channel out today. My name is Agabus. This is your financial education channel. Today we're reviewing some basic investing concepts such as stocks and bonds and ETFs. Over here at annuity.org, bonds and stocks tend to be the most general, generic, basic form of investing that most people will put their money into. A bond, according to annuity.org, is a financial security that represents a creditorship arrangement with the issuing entity. You can think of a bond as a loan, as another way to put it. It's a debt, it's a loan, mortgage, car loans, credit cards, any sort of type of crediting position is really what a bond is. On the flip side of a stock, according to annuity.org, is a financial security that represents an ownership interest in the issuing entity. So one other way to look at it, stocks versus bonds, if you own a home as you're paying down the debt in this case is a mortgage, and that can be considered a bond. As you're paying the debt down, you are growing equity inside of the home, and you can look at equity or ownership similar in a way as you can to stocks. Continuing on, as we mentioned before, stocks are an equity instrument, also ownership in a company, while a bond is a debt instrument or it is a loan toward a corporation or a government entity. The returns are slightly different. Stocks can receive dividends if you own a dividend-producing stock, and bonds don't have dividends. They have what's called interest or interest payments. Both stocks and bonds can go up and down in value separate from the return. However, this is an additional way to get some return on these investments. Stocks, is there any return of guarantee? No, there is not. You could lose all of your money when investing money in the stock market. And if the stock you decide to purchase were to go belly up, well, ownership or stock ownership is the last on the list when it comes to the company liquidating, going through bankruptcy, and paying off all the different. A bond is slightly more conservative than the stock is because if a company gets liquidated through bankruptcy, the bond holders get paid out first compared to the stock holders. Bonds, as I mentioned, can have some interest. Interest is based primarily upon the issuing company, the issuing government, and what interest rates are at the moment. Another way to get some return or some yield or have some rise in your value using bonds is when interest rates go down, the value of the bond goes up, and vice versa. Taking a look at stocks versus bonds, it's good to have an understanding of what the correlation is. Generally speaking, stocks and bonds will have a opposite correlation, meaning if one goes up, the other goes down. That's why stocks and bonds tend to be the most well carried in a portfolio and the most well used in a diversified portfolio. As you can see here, US large cap stock and bonds, the correlation is very low compared to some of the other sectors that are out there. Gold is one as well, but gold tends to be very old school. Nobody likes to invest in gold, and to be honest, why would you when Bitcoin is around? Another thing to look at when you're comparing stocks and bonds or ownership versus debt is some previous return. Broadly speaking, bonds will be the type of investment that does not perform or keep up with the stock market, but the bond market and bond funds and individual bonds are much more conservative than investing in the stock market. As you can see here, when we go back to 2023, the annual return for large cap stocks in the green was 14%, followed by some small caps, real estate investment trusts, and then finally these high yield bonds is when the bonds finally show up. And then all the way at the bottom here, you've got commodities, cash, and fixed income. Again, fixed income, broadly speaking, is bonds as well. And one more time for the people in the back, when you look at the stock market, this is in the green area here and bonds in blue. This is brought to us by jpmorgan.com. You can find this exact same report online for your own use. In any 1 year, if you're investing in the stock market, you can see some pretty big phenomenal swings, high highs, low lows, like a big roller coaster. And the blue here would be bonds. You don't see as high of high and as low of lows. So broadly speaking, they're a bit more conservative. And also for illustration purposes only, this gray is a 60-40 portfolio where 60% is held in the stock market, 40% in bonds. you can see it starts to flatten out some of that volatility. And the last instrument that we're going to cover today is ETFs and mutual funds. Mutual funds have been around for, forever. I think the earliest one was in the 20s. ETFs are much newer to the industry. However, in the last 10 or 15 years, they've really gained a lot of popularity. When you look at a mutual fund and an ETF, both of them are going to be pools of money, pools of people putting their money together in order to buy individual stocks and bonds. A couple biggest things I like to point out is passive ETFs on the left here. This is from creditkarma.com. Those tend to be index funds. They tend to have very low internal expenses of the fund, and they tend to follow or track a benchmark. The mutual fund on the right tends to have much higher internal expenses. They've got a big team, a very large overhead for the fund, and generally speaking, high fees, and those funds do not track very well the benchmark that they're supposed to track. Those are just some of the instruments we're going to cover here today to get a general idea of investing, again, using stocks, bonds, and different types of funds. If you found this information helpful, please subscribe, hit the like. If you found this information helpful and you think somebody else would, you can share by hitting the share button below. If you like what you saw and you want to help the channel out, hit the like button below, subscribe if you want to see more, and hit the bell notification to get notified every time I upload content. Thank you so much for joining us tonight. I'll talk to you soon.